This is going to be a pretty short video, and I made it because I was surprised when a recent comment had asked what a limit order was in trading. And this was from someone who suggested that they were ready to go live with their trading account, so that's a bit of a concern. And look, yeah, there are a few ways that you can enter your position when whatever setup shows up. And the one that you use, that could actually make a difference in the outcome of your trade. And if you're still deciding what a trading setup means to you, you can download this free price pattern guide, and that might spark some thoughts for you and get you moving forward here. So back to orders. Look, each one is going to serve a different need. So let's cover what I think we should be calling Trading 101. And the first one is a market order. And this is probably the most basic trade entry you're ever going to make. And all that is when your buy, your sell signal shows up, you enter the market at the market, which means whatever price is available at that time. And you would use that if you need to get into a trade quickly or get out of a trade quickly. Why you'd want to get into a trade quickly, I don't know. Out of a trade quickly, I could see if the market had made a really good move in your favor, you'd want to click out of that and take that gift the market gave you. The issue with these, though, like I just touched on, is that the bid and the ask price is always fluctuating. So if you see a price of $1.34, for example, and you want to enter a buy by pressing buy, by the time that order happens, price may have gone down or up. And if it goes up, you just bought more expensive. And with down, you got a cheaper price. And if you've ever traded Forex and you tried to trade the FOMC release, you've probably seen that using market orders get you into a trade at a worse price than you had planned. What's that going to do? It's going to increase your risk, and it's going to skew your position sizing model. What about limit orders? And I like these types of orders because these orders are only filled when the price reaches the price that you've chosen to enter the market at. And the brokers use the word limit, some of them, to describe all types of limit orders because it has two names. And it depends whether you're buying or selling. So a buy limit order, what you're doing is setting instructions to buy if the market reaches your price or lower. Buy limits are always below the current market price. And you would also use the buy limit order to take profits if you're short a trade. The sell limits, the exact opposite of buy limits. Your order to enter the market short is set above current price. You'd use that in a range, just like you would use a buy limit order, for example, in a range trading situation. And the positive of setting a limit order, the good thing about it, is that you get filled at the price you choose. The negative, though, is price may almost reach your entry price and then turn around, just leaving you on the sidelines without getting a fill, not being in the trade. And for some of you, you guys would just hit buy or sell and get into a market order. So if you're trading long trading, you could use a sell limit as a means to take your profits. What about buy and sell stop limits? What I like about these is they do not convert to market orders when they're hit like the other limit orders do. So these are going to prevent you from buying or selling at a worse price than you intended. So as an example, the market's going up. So instead of using a buy stop that can get you slipped, the buy stop limit will prevent a higher price order, but it can get you filled at a lower price than you expected. Stop orders. What I like about these, they're interesting. They have a unique quality, is they're both a limit and a market. So basically these are opposite of the limit orders. So if you choose to enter a market long, setting a buy stop order has you setting an order above current price. And sell stops have the order set below current price. The main drawback when you choose to use a stop order to enter the market is the same drawback that you're going to get with market orders, and that is getting filled at the best possible price, which could be the worst possible price for you. Okay, that means you can suffer from slippage. So when you're designing or you're testing a trading system, you have to keep in mind that slippage can and will have a direct impact on how profitable your system is. Stop loss orders. This is one of the most important, if not the most important order you should know. When you're in a trade, these are the orders that will get you out if the trade's not doing very well. But it can also get you out of profitable trades if you're trailing the stop behind the price to lock in the profits. And a lot of traders love the set and forget ability of setting a stop loss order because you're essentially safe knowing that the risk that you can tolerate is protected by a stop order generally, and you don't have to remain glued to the trading screen, right? So you make sure you set one when you enter a trade, but remember too, you could also get slipped on these as well because a stop loss order converts to a market order when the price gets hit. So let's close this up here. And like I understand, it could be a little bit confusing when you're learning about the different orders that you can use. But the trick is to ensure that you know them well enough that you don't choose the wrong one when entering a trade. So when you're learning a new order entry system or just a trading platform in general, ensure that you've gotten used to placing the different types of orders depending on however you're going to trade. Thanks for watching.